The Fed met last week, and we've got the May market update for you next. You're definitely going to want to watch this one. I don't know which question is bigger. What did the Fed do at their last meeting, or how's the real estate market? So we're going to start with the latter because that seems to be the most common question that I get is how's the market? What's going on in the market? So let me give you the May sales data for the greater Philadelphia area. So this is for the city of Philadelphia, Chester, Delaware, Montgomery counties. We're going to break it down all here right now. What's happened year to date? So the number of sales are down 25.6 to 28.1% year over year through the end of May. Median sale prices up 1.8 to 5.6% in the suburban counties, and it's down 5.2% in the city of Philadelphia. The number of new homes that are pending are down between 19.2 and 27.3% year over year. So a little bit of a more lead indicator than number of closed sales, which I gave you earlier. Number of new listings are down 16.3 to 25.4%. Inventory and supply, what we're seeing right now in the suburban counties, Chester, Delaware, Montgomery County, we're seeing a 0.88 to 0.92 month supply, meaning there's just about a month would go by where if no new listings came to the market, everything would sell. And in Philadelphia, we're seeing a 2.77 month supply. Days on market is ranging 22 to 26 days in the suburban counties, and it's at 54 days year to date in Philadelphia. And the percentage of the asking price received year to date in the suburban counties is 99.4% to 101.2%. So basically right at or just above the asking price. And for the month of May, that number went up to a 101.6 to 102.8% range. We're seeing that there's some typical spring competition for offers right now. People are going a little higher above the asking price than they were earlier in the year. In Philadelphia, we see 93.9% year to date and 95.5% in the month of May. And lastly, what's going on with interest rates? So the Fed did meet last week, and rates have been very steady. We're seeing rates come in around 6 and 7/8% is where people are locking on a 30-year fixed, and that number's been pretty solid there. It jumped up to 7 one day, came back down about 1/8 of a point to 6.875 the next day, and it's been steady there. What we're seeing coming out of the Fed meeting and the comments from Chairman Powell afterwards are that there's likely going to be a couple more rate hikes later in the year. They didn't hike rates at their June meeting. They kept everything where it was, and that led to some stabilization in the market. They're also monitoring inflation data, which is still higher than where it was and not where we were running previously, although the CPI data, the Consumer Price Index is what that stands for, the cost of goods that are purchased, has been pretty favorable and been coming down based on the report from last week. So we have some positive things going around inflation, which caused the Fed to pause the rate hikes, but they are telling us there's more coming. So we're going to have to see how the market reacts to all this, and we'll have to see what happens in the labor market. That seems to be the domino that the Fed wants to break here, that when we see unemployment rise, which I don't think is a great idea for anybody, when we see unemployment go up, that could be what the Federal Reserve is looking for to pause their rate hike policy for good. So that's my takeaway from this. A lot of economists out there, George Ratu from Keeping Current Matters and formerly Realtor.com, is clear that we're going to see rates kind of bounce around where they are in that 6 to 7% range until we see the labor market break. Logan Mohtashami from Housing Wire is saying the same thing, and that's why we have this really large spread between the 10-year and where mortgage rates are. And that's really a measure of risk, and people are waiting for inflation to cool down and unemployment to go up. So that's kind of the takeaway from the Fed meeting. Now, what that means for the market, looking at all this data here, is this. We're seeing that rates aren't really moving around as much as they were earlier in the year. And a lot of buyers are rate sensitive right now. And what I recommend for buyers is this. If you're serious about buying a home, you're serious about transacting, then I'd be looking at what monthly payment am I okay with and reverse engineering what that looks like and determining your price point. Because I don't see these rates going up or down too much anytime soon. Later in the year, I do believe we see rates come down a bit. A lot of this is going to depend on some of the Fed policy decisions. But if you've got a need to buy a home right now, I'd be looking at some of the temporary options that are out there, like the 2-1 buy down, which means you can buy the rate down with a certain fee paid, 2% in your first 12 payments, 1% in your second 12 payments, and grow into the payment. I'd look at what points will cost me to buy down the rate, and I'd look at how do I maybe deal with the monthly payment and manage the monthly payment rather than get focused on the rate, because when rates go down, you will have the ability to refinance. This isn't a guarantee. This isn't some promise that's going to happen. It's just the reality of if you want to buy a house right now, waiting is still going to cost you money when it comes to the equity that you're building. When you look at what's happening with prices, we're seeing prices continue to increase. That hasn't slowed down off the normal trends that we've seen in the past. Think pre-2020. Obviously, it's a lot less than the unicorn market. So what I'm clear on is that this is the market we're going to be in. And until something breaks here with the employment rate and the labor numbers, we're not going to see rates come down substantially. I do anticipate it will happen later in the year. If I'm a seller right now, we're seeing that, just look at the list to sales price ratio there. For the month of May, we're seeing 101.6 to 102.8 in the suburbs, and another 1.6% increase in the city. So we're seeing you're getting a little more for your home right now. This may not last forever because inventory is still very low. So if you've got a place to go, or you're willing to maybe put a little more of your cash into a property to get a lower payment, now may be a time to do that, and you can look at the rate and the monthly payment later. The whole message here is that rates aren't going to go down anytime soon. If you're waiting for rates to go down, it's going to take some time based on what the Fed did and what we're seeing in the market. Prices are still healthy. Just because we're seeing housing slow down doesn't mean prices are going down. That's been very clear, and that's the biggest worry for a lot of folks. All the more reason you should be talking to someone who knows what's going on in your local market so you can get great advice.